the assets that do well in stagflationary periods happen to be the ones that are the most undervalued right now. And of course, the emerging market stocks have done very badly for the last 10 years compared with the major market stocks.
We're talking about the major investment themes of the rest of 2023 and 2024 with Adrian Day, president of Adrian Day Asset Management and portfolio manager of the Euro Pacific Gold Fund. Welcome to the show here in Memphis, Tennessee at the Freedom Fest. Good to see you live. How are you?
And you, David. It's been a while. I'm fine.
Yeah, it's been a while since we met in person. Good to see you. Let's talk about the equity markets first. Everyone's been talking about how sentiment is shifting towards a more bullish stance. If you're just bullish now, you would have been, you would have missed the boat a little bit, but never too late, right?
I disagree with that. As you know,
Okay.
Never too late. No, I think the markets are very overvalued right now. I'm basically a value investor. I look at valuations as my starting point. And let me just say, a lot of people, they think when a value investor says the market's overvalued, he's making a prediction. I'm not making a prediction.
Right.
The point of saying the market is overvalued is not to say that the market's going to drop.
Sure.
And it's certainly not saying that the market's going to drop anytime soon. It's just saying there's a risk in the market right now. So I would say the risk in the market is very, very high. As you said, you've got, not only very optimistic sentiment, but it's increasingly bullish. Sentiment is increasingly bullish. And you can look at call option ratios. You can look at all sorts of things to see the sentiment is bullish. When sentiment gets increasingly bullish at high valuations, that is always a danger sign to me. You want sentiment to be getting more bullish when stocks are cheap. That's number one. Number two, we're trading at nearly 21 times earnings right now. That is not as high as the dot-com bubble, but it is a very high multiple on a historical basis. And similarly, price to book, price to the yield, they're all telling you that the market is very, very overvalued right now. So I think the risk in the market is very high, and it's not priced in at all. You look at analyst consensus estimates for the next 12 months of earnings to be about 1.5% lower than the last 12 months. When you think that the last 12 months included that big spurt coming out of COVID and lockdowns when earnings shot up, I think to say earnings are only going to decline 1.5% is pretty optimistic, frankly.
Would you agree or disagree with the notion that when everybody is starting to shift towards, well, not everybody, but when a large number of people, mainstream and perhaps economists alike, want to shift to a more bullish stance after the markets already rallied double digits, that signals a top when everybody wants to get it?
Absolutely. No, I thought I had said that, but you said it so much more eloquently than I did. No, absolutely. Absolutely. You want to see people, if you start seeing sentiment shifting to bullishness at low valuations, that's a positive sign. Like if we start to see people get more bullish on gold stocks, that would be a very positive sign. But to see them get more bullish on markets that are so expensive.
Well, when someone says that markets are expensive based on valuations, what are you comparing those valuations to? Historical precedents?
Yeah. I'm looking both at absolute terms and also historic precedents. By absolute, I mean if I put $100 into a stock right now, I want to know how long is it going to take for me to get my money back. And there's different ways you can look at that. Obviously, the dividend yield is part of my return. But if stocks are trading at 20 times earnings, right? We've got to go 5 years before that multiple. We've got to go a longer time period for the return, the earnings, to pay me back. Is what I'm trying to say. Didn't say it very well.
Yeah.
So when you're pricing at 20 times earnings, it just takes you a lot longer to get your return back than when you're starting from 5 or 10 times earnings.
I want to show you this chart, which I'll put on the screen later for the audience. This is the probability of a recession as produced by the New York Fed based on the Treasury yield curve. Now, it's pricing in currently a 67% chance of a recession, I guess, by June 2024. Now, why is it that the bond markets seem to be pricing in a recession, whereas the equity markets either aren't pricing in a recession or have already priced in a recession, and that's somehow the bullish news for equity markets.
I think there's two factors there. One is that the bond one thing to say is that the bond market tends to be a more accurate predictor. It generally has been so over the last 50 years. The bond markets tend to sniff out recessions, inflation before the stock market. I think the other factor is that you've still got excess money in the system. We've had 15 years of excess money creation with interest rates, at zero lower bound for most of that time. And, that money, a lot of that money is still there. The money has to go somewhere. So people are still buying stocks because they have money, if that makes sense. And they're still buying real estate because they have money. We're seeing the end of that phase, I think. So, I agree completely. You didn't say it. I agree completely that we're heading into a recession. All of the indicators are showing that, whether you're looking at the leading economic index of the Conference Board, whether you're looking at the yield curve. The 3-month, 10-year is the most inverted it's been in, 40 years or something.
Sure. Well, that just leads me to my ultimate question, which is where the investment opportunities are currently.
Well, I think we're heading into a stagflation, and I think we're heading into a stagflation because, to me, a recession is baked in the cake right now. I'm not talking about a 1930s-style depression, but just an economic slowdown is baked into the cake, and yet we're going to continue with inflation. Inflation's going to be stubborn. So right now we're going through a sort of respite in the inflation rate. Part of that is because the oil prices come down, and that feeds into everything, had come down. And part of that, of course, is the base effect. We're now comparing this month's inflation to last year's June, and so on. And so the comparisons are a lot easier. If you look at, as we go a little bit forward, like 6 months from now, those comparisons are going to start to get more difficult again, right? Number one. Number two, if the oil price reverses and moves back up, which it seems to be doing, not today, but it seems to be doing, that feeds through into everything. It feeds through into transportation. It feeds through into the prices of goods in stores that have to be, shipped around. And so by the end of the year, I wouldn't be surprised if we see 3.25%, 3.5% headline inflation, maybe 4%. And that will be the sort of new norm for a little while. So if we have 3.5% inflation at the same time as the economy is falling into recession, stagflation. To answer your question, I'm sorry. What does that mean? Well, in stagflationary periods, both in the U.S. but also from studies of stagflationary periods around the world, gold tends to do well because your currency tends to do badly. So if a currency does badly, gold tends to do well. Gold stocks tend to do well. Gold stocks, contrary to what one might think, tend to do well in recessions. So I was surprised when I looked at the statistics, to be honest. But if you go back to the 1960s, we've had, 7 recessions in the U.S. since the 1960s. Gold stocks actually rose for a majority of those.
Right.
And for some of them, they were up, 50 to 100%. And in the minority where they declined less than the S&P declined.
It's interesting you bring up gold as a hedge against stagflation. We think about gold as an inflation hedge. It's interesting because gold has also hedged against deflation.
Right.
During 2008, when there was a recession, gold went up during the recession, and of course there was a brief period of when we had a deflation print in the CPI. And so gold wasn't really hedging against inflation, it was just hedging against an economic downturn.
That's right. And gold is typically, I call gold a chameleon investment because it hedges you against a lot of different risks, some of which are contrary.
Sure.
So inflation is one and deflation is another. Gold has actually performed better during deflations on a historic basis. It's performed better during deflations than it has during inflationary periods.
Sure.
In real terms. So gold tends to do well during stagflationary periods. The gold stocks do well. Oil, other commodities tend to do well. Smaller markets tend to do well. Emerging markets are small. I don't like to say emerging markets because now emerging markets are some pretty weird and wonderful markets. But let's say smaller markets tend to do better. And what does badly during stagflations are developed markets, US and other major markets around the world, stocks and bonds. They tend to be the worst performing assets of all in stagflations.
Right.
And that scenario matches very well where I see overvaluation and undervaluation today. I see global stock markets, major markets, as very overvalued. Not just the US, but other major markets as well are overvalued. Bonds are at the end of a 40-year bull market. Bond markets tend to be very long. The cycles tend to be very long. So they peaked, the yields peaked. So the bonds bottomed in 1980. And then the time before that was like 1950, 52 or something. So we have these 30, 35, 40-year cycles in bonds, and that's historically true. So bonds are at the end of a bull market cycle. I don't want to be investing in bonds.
Yeah.
And yet on the other side, gold stocks are incredibly cheap. Excuse me. With the XAU, the major gold and silver producers, selling close to their 20-year lows in valuations, even though the price of gold is at 1950.
Sure.
Commodities, you look at the whole commodity index versus the S&P, we're basically at 100-year lows. We're not saying the commodity prices are at lows, but relative to the S&P, they're basically 100-year lows. So the stagflationary, the assets that do well in stagflationary periods happen to be the ones that are the most undervalued right now. And of course, the emerging market stocks have done very badly for the last 10 years compared with the major market stocks.
Let's unpack your stagflation thesis. So there's two parts of stagflation. There's low growth and there's high inflation.
Right.
Let's talk about inflation first. CPI print's been coming down. The latest reading was 3%. So continuous decline in the rate of inflation. Why do you think inflation will eventually go back up?
Well, remember the core inflation, which the Fed prefers to look at, the core inflation, which is the more sticky part of inflation,
Yes.
is holding up, is still much higher.
Core PCE is still at 4.6, I believe.
I thought it was 4.7.
4.7, yes,
yeah.
4.7.
And then the core CPI is 4.1, I think. So the core is holding up a lot strong, a lot higher than the overall. And that tends to be the more sticky. So that's number one. Number two, we're going to get the base effect. The base effect is helping inflation come down right now.
Yes.
Because it was higher numbers last year.
Yes.
But as we move through to the end of the year, we're going to be making comparisons with lower numbers.
Right.
And so therefore it'll be moving up. And then the last thing is oil. As I said, if the oil price moves back up, then that's going to affect the cost of everything. Transportation, the price of goods in the stores. That's going to have a big impact on everything.
Why would oil move up during a recession?
That's a very interesting question. I think anytime you look at any market, there's obviously factors on this side, there's factors on that side. And the job of the analyst is to look at all of the factors, try to put them on one side or the other, try to weigh how important each factor is. There's no question that if we go in my mind, there's no question that if we go into a serious global recession, and again, I'm not talking 1930s, just a global recession, then the demand for oil will go down. I mean, that's obvious. And so I'm not one of those huge oil bulls, in the near term. But on the other side of that, you've had gross underinvestment in capital investment in large oil projects for the last several years, which has only got worse in the last few years with the ESG, an anti-oil movement. And so we have underinvested in oil, which means we can keep producing from investments that we made 10 or 15 years ago, but that eventually catches up with us. And that's actually a theme you see in pretty much all of the commodities of just underinvestment.
So all commodities are going to see a rise in prices.
I think so.
Why have all commodities been underinvested in?
Well, oil is worse than the others because of ESG.
Sure.
But most commodities have some kind of, if you like it, soft ESG sort of component.
Okay.
They're becoming more difficult to permit. You're getting more opposition.
It's not a lack of resources that's the issue.
It's not a lack of resources. It's a lack of easy resources in friendly jurisdictions.
Okay.
So we're going to more difficult deposits. This is painting with a very broad brush.
Sure.
We're going to more difficult deposits in more unfriendly jurisdictions. And so it's taking longer to permit, which means more money. It's these projects are getting more opposition. I mean, every mining development around the world now gets the NGOs come in, to oppose a project on this environmental ground or that environmental ground. But the gross and part of a reason, of course.
Don't forget nationalization.
And don't forget nationalization, yeah. Or soft nationalization, as you see in places in North America, or Mexico, for that matter. So the underinvestment has also come from just bad returns. You go back to, you look at returns in mining over the last 50 years, and the mining sector has actually had a negative return on invested capital. They've raised more capital than they have got back in profits. That's not conducive to big firms giving you money. So if Consolidated Ajax or whatever comes around saying we're doing a private placement and we're raising $2 million,
yes,
will you give us $5 million? Well, yeah, they can get to their, not 5 million, sorry, 5,000. Yeah, they can get to their 2 million. But can a project that needs, 2 billion or 6 billion, can they go to the big firms and get capital? Is much, much more difficult now than it was 20 years ago, just because those returns have not been there.
What do you think will be the most valuable resource going into the next 20 years? I'll let you define valuable however you like.
Yeah, okay. I will define them in different ways.
Okay.
I think in terms of risk reward and preservation, gold is by far, and we're talking for investors now,
sure,
by far the most valuable resource to have. But from the point of view of which is likely to have the biggest return, I think copper is definitely a contender for that, both because of the demand side, which has changed with EV and electrification generally, but also the supply side, because that's been very, very underinvested in the last few years. And it's big copper mines are very, very rare. So, you can go and get a, let's say you can find a gold mine in Nevada or somewhere that'll produce 100,000 ounces a year for 10 years, and it costs $100 million to capex.
Yeah.
And that can be a valuable mine. Copper, if you convert those ounces to pounds, you wouldn't even look at a mine that size. You wouldn't even think about it. So copper mines tend to be much, much larger, and the really big mines are extraordinarily rare. So if you look at the top 10 mines in terms of production and the top 10 mines in terms of reserves,
right,
over half of those mines are more than 100 years old. And you look at the last major mine that went into either category, top 10 producers, top 10 reserves, was Oyu Tolgoi, which was, that's got to be at least 10 years ago now, right? And the one before that, the major one before that would be Grasberg, the major one. So, they're very, very rare. And we haven't been really looking for these huge deposits for a long time.
Let's pivot to the Fed. Will the Fed pivot?
Will the Fed pivot? I think you have to look at what you mean by pivot. When people talk about a pivot, what they really mean is the Fed's going to raise, stop, and then start lowering them. I don't think we're going to start seeing lower rates anytime soon.
Sure.
Well, excuse me. I don't think we're going to see the Fed start to cut rates soon. Even over dot plot, I should point out, I mean, the Fed members themselves are talking about rates coming down next year and the year after and into 25. So the Fed itself, not Powell, but Fed members are looking at rate cuts next year. But I think at some point the Fed is obviously, the Fed is going to stop raising rates at some point, and at some point they're going to start cutting them. You know, what's going to make them cut, in my mind, is not a slowing economy, not a rising unemployment, because Jerome Powell, as we talked about last time, wants unemployment to rise. Now, he doesn't say Yes, he doesn't say my goal is to raise unemployment.
Right.
But he wants aggregate demand to come down. How do you get aggregate demand to come down? Well, by people having less money in their pockets. So, and the most effective way of doing that is to put people out of work. So he wants aggregate demand to come down, and that implies a higher unemployment rate. I don't think he's going to stop at a higher unemployment rate, a lower a recession, a lower stock market. I don't think he cares too much about the market. What will cause the Fed to pivot, in my mind, will be another financial crisis of some type, whether it's more banks failing, or whether it's pension funds, or whether it's insurance companies. You know, people seem blasé. Not the stock market, incidentally. The stock market has priced in the risk in insurance companies, but you know, people don't talk about insurance companies going bankrupt. Now, you have some major insurance companies say they cannot afford to meet their liabilities. The Fed's going to step in. There's no question.
Right. It just occurred to me, you mentioned reducing aggregate demand. The Federal Reserve can lower or control prices indirectly by controlling aggregate demand. If you were to make the labor market a bit tighter by perhaps making monetary policy tighter, could they control the supply side of the equation? Any way they can do that with monetary policy?
Well, generally speaking, just increasing interest rates does control the supply side as well, because it makes returns less positive.
Yes.
And so people don't invest so much and don't produce so much.
Right.
But I think the Fed has gone just about as far as it can on interest rates. I'm not saying they're going to start cutting rates anytime soon, and I still think we probably have two more. I mean, the one later this month is kind of baked into the cake, I think.
So one more, and then
I think we'll have another one this year. And that's more or less what what Jerome Powell has talked about.
Let's see what the Fed Watch tool says here. So they've priced in pretty much one rate hike by July. Jerome Powell has not removed the possibility of another hike, two consecutive rate hikes. So markets are pricing in no rate hike by September.
Well, there is no meeting in August. So what are they pricing in?
In September, in September, they're pricing in no rate hike. So 83% probability of 525 to 550 basis points by September.
Okay.
So that would be in line with one hike after July, no more hikes in September. And in November, in November, they're pricing in a 27% chance of one hike in November, which is higher than 14% in September. So markets are pricing in another pause. Basically.
Are you recording this?
Yeah, we are.
I think that makes sense. I think July's is baked in, and obviously there's no meeting in August, so they have an effective pause. And I think what Powell would like to do, he's talked about slowing the pace. He's talked about that himself. Right? And I'm not a Fed apologist or a defender of Jerome Powell by any means. But I mean, I think first of all, you should at least start by looking at what has he said.
Yeah.
And he's talked about slowing the pace of increase, which would go along with saying no rate hike in August, no meeting. September, probably not. That would be another pause, but depends on the data. And then another one in November or December.
Final question. any assets would suffer from 2 more rate hikes, or is everything pretty much already baked in?
I think two is, I won't say baked in, but the market's sort of, I think, expecting two. But I think the thing about rate hikes, and particularly higher for longer, the thing we have to remember is that every incremental increase, even 0.25% on 5%, hurts some more people.
Yes.
There are some households, some businesses where 5%, we can just about make it, and 5.25%, it's just too much. Credit card debt goes up to 22%, up from 14%. That hurts people with credit card balances. The business that termed out their debt till January of 24, well, they're okay in July, August, September, October, because they're not renewing their debt. But when they have to roll over their debt, it hurts them. So every incremental increase hurts a few more people, and the longer you keep those rates high, more people are brought into the net and are close. So, and it's the same for households. It's the same for businesses.
Are you concerned about defaults on consumer loans, mortgages at all?
Absolutely. That's why I think people who talk about the consumer's so healthy are just because of consumer spending, are just absolutely missing it. If consumers continue to spend, but they're spending from their savings first of all, then they're spending on credit card debt, and now we're starting to see credit card defaults move up significantly.
Yes.
Well, but consumers simply can't continue spending at that pace. So I don't think the consumer's healthy at all. And, these things, we've talked about this before, these things have long lags, and people tend to forget that. The first interest rate hike was, April a year ago? So some of these things take 18 to 24 months before the lags are noticeable in the economy. So I think it's far too soon to say we've escaped a recession.
Very good. Where can we learn more about you?
www.adriandayassetmanagement.com.
We'll put a link in the description down below. Thank you very much, Adrian.
Thank you.
Pleasure to see you in person. Thanks for being here, and thank you for watching. Stay tuned for more.